In this video, I'm going to discuss how we account for purchase discounts related to inventory items. Now, even though I'm choosing inventory as the setting to discuss purchase discounts, the items that I'm going to discuss here can apply in other scenarios as well, not just regarding inventory. But let's go ahead and look at it from this perspective. So the main thing is we have two main approaches people can use to account for these purchase discounts, and it really makes no difference what method you use because ultimately we end up with the same things. And I'm going to explain how that's the case here. So if you use the gross method, what ends up happening is that you record everything at the full amount, and if later on you take purchase discounts, then we adjust for that. Whereas if we use the net method, we record the purchase at the amount assuming that there's a discount will be taken. So we net out the discount up front. Okay, so let's look at the example here for the gross method. Assume we buy inventory for $100 and we include that as part of our inventory, and then accounts payable goes up by that same amount. The seller, since we're buying this inventory, the seller that sold us the inventory is offering us a $5 discount if we pay within the discount period. So let's assume two possible scenarios here. One of them is we pay with no discount. In other words, we do not take advantage of the discount. And if that's the case, when we pay the $100, it would just be a reversal of the accounts payable here, and then we credit cash for $100. Straightforward. And under this particular scenario, overall, we are going to reflect the fact that the inventory cost us $100. Now, alternatively, and this is one or the other. Okay, it's obviously it's you either pay with no discount or you pay with a discount. So the alternative is maybe we paid on time, early, not on time, but early in order to take advantage of the discount, in which case we get a $5 discount. Now, if we get a $5 discount, we got to keep in mind that this inventory item that we initially recorded at $100 will be overstated because of the fact that we got a $5 discount. So the mechanism that we're going to use to reduce this overstatement of inventory is through the use of the purchase discount account. Now, notice how I say here that it reduces the inventory account. So if this account called purchase discount reduces the inventory account, then we would call it a contra asset or contra inventory account. So the way I would do that is reduce the accounts payable, the liability for the full amount. I'm going to send a check for $95. So the difference is going to be recorded as purchase discounts or an indirect reduction of inventory. Okay? And by doing so, I'm reflecting the fact that overall, this inventory cost me $95. I'm taking care of the potential overstatement in inventory that would have occurred if I would not have used this purchase discount account. Now, that's using the gross method, right? If we use the net method without going into the details yet, notice how I emphasize here that the cost reflected over the whole transaction is the same as if we would have used the gross method. So it doesn't matter whether you use the net or gross method. Overall, you're going to reflect the true cost of the inventory item, and that's what's important. So, why would some companies prefer the gross method over the net method? It's really just a company choice. Maybe you have a company that is normally taking advantage of the discounts. In general, takes advantage of the discount. So for that kind of company, it might be more efficient to just record things at the net amount. Or if you have a company that doesn't necessarily have that approach, they might want to use the gross method. And sometimes companies want to use the gross method even if they take advantage of a lot of discounts, for the simple reason that having this extra account here allows them to do analysis of how often they're taking advantage of the discounts. In other words, if we had the net method, where we record things at the net amount, the $95. Inventory goes up, AP goes up. Then later on, when we pay it, all we got to do is reverse the AP and then credit cash. This here, while efficient, may not allow us to later on do analysis of how much in discounts we're taking advantage of. Whereas this, having this account, is information for that purpose, because you might be doing this for the analysis based on each vendor, or in examining the performance of the accounts payable department, or many other reasons. So it just provides additional information. But for a company that just wants to use the net method, it's the same. They could look at it from the other side. So if you use the net method, you'll use this account called purchase discounts lost if you do not take advantage of the discounts. So if that's the case, you would classify this as an expense, as a finance charge. So notice what happens here. We buy the inventory at 90 and we record it at 95, even though the invoice is for 100. So when we later pay with no discount, we debit AP, we reduce the liability. We got to send a check for the full amount of 100. So we debit this purchase discounts lost. Now, at the end, it's as if our inventory cost $100, because when you sell this inventory item, it's going to go to cost of goods sold for 95. And then the additional $5 will be considered a finance charge for that inventory, which is an expense. So you have cost of goods sold being an expense of 95, and then the finance charge being $5, so that's a total of 100. So it's as if our inventory cost us $100. You're expensing 100 for that inventory related transaction. All right, and then here on the other hand, before I go there, so by using this purchase discount account, we can also analyze our efficiency, or how well we're doing in terms of taking advantage of discounts. If you're using this account to do that analysis, then you want to maximize, you want to see the maximum usage through the purchase discount. If you're using this account to see how well you're taking advantage of discounts, then you want to see the minimum amount in this account, right? If you're doing a report. So you might do it on a percentage basis. What is PDL over AP? That gives you a ratio of how large or how often you're using this. Or if you're using this angle, then you go purchase discounts over AP, and you want this ratio to be larger, whereas you want this ratio to be lower. So it just depends on your preference. But at the end of the day, the key thing here is this: when you go out to a client, they're not necessarily going to call it the gross method or the net method. You would just pick up on what they're doing based on the accounts that they're using, right? If they're using purchase discounts, then you can see that for those type of transactions, they're using a gross method. Or if they're using something similar to this, then you can pick up on the fact that they're using the net method most likely. All right, this concludes the video on purchase discounts.